Thanks everybody for joining us. This is Jaffee. I'll introduce him in just a second, one of our good friends. Thanks for joining us on a Tuesday morning at 8 a.m. bright and early. Beautiful day here in the Pacific Northwest. We are going to talk investment properties, financing investment properties, all sorts of stuff around that today. From a logistics standpoint, I will be moderating, asking Jay some questions and kind of an open dialogue as we roll forward. Jay Jaffee has been a buddy of mine for 10, 11 years now, helping out in the mortgage space. He has an office here in the Tigard area and has been a really good resource to many of our clients. So really excited to have him here. He's quite a character, so we'll get rolling. He has a puppet that he likes to use sometimes. I don't know if we're going to see that or not today, but he is definitely one of our favorites. So a little housekeeping as we get started. The first thing is this isn't intended to be investment advice or specific advice to you, but really an open dialogue that can really get your brain turning. If you want specific advice on taxes or mortgages or loans, financial advice type of stuff, make sure you consult with your professional team. That being said, any of you that have attended our webinars in the past, we use this program called Slido. It's really nice. It's an online anonymous question and answer system. So it's kind of like you just log in on your phone or your computer to this slido.com or sli.do, and you can just enter a question. You can thumbs up questions that you like if you want to move them to the top of the list if it really gets going on the question thread. So there will be prompts as we go through down at either the bottom or the tops of the slides as a reminder. So because of the nature of as many people as we have on the call, we can't open it up to anyone talking. Raising the hand function or any of that has been disabled. So this will be your way to interact with us. So again, you can pull that up and kind of enter your questions there as we move through this. We will get Jay's contact information up again at the end if you need it, but for now, that's kind of the beginning. Question, kind of kick things off. When we're talking with clients and having conversations, it's very popular today to be considering multiple properties, investment properties, second homes, all sorts of different stuff. So kind of our tongue-in-cheek question that we want to kick things off with that really frame the reference is what's more expensive than one home? Obviously two homes, whether it's homes or investment properties. If we think about the wear and tear and depreciation and upkeep that needs to be taken care of on a property, obviously having two is probably more expensive than having one. Depends on how big the first one is versus two smaller ones. But as we go in today, we really want to have, I want to walk away today, Jay, with a better understanding of how I might be able to pull off an additional property, whether it's an investment property, a vacation home. I want to understand some of the loaning function around that, how I can maybe position myself or my current investments equity to potentially add real estate in some capacity beyond my primary residence. So that's my hope today, get a better understanding of how, normal people like you or me might be able to pull that off and hopefully have a little bit of fun along the way.
Sounds good.
So kind of getting started, when we're kicking off planning conversations with clients, we're often, the question comes up, I'm interested in real estate. I've read some real estate books, and I've heard that real estate's amazing. Really the first question we have to ask is, what kind of property we want to add? Some people want to add a second residence for lifestyle purposes. So in lifestyle purposes, that may be, vacationing in, or wintering in, another warmy, sunny, destination, whether it's, Arizona or California or Portugal or, somewhere other than here, for kind of just fulfillment of life and enjoyment, legacy, memories, experience, that sort of thing. Long-term rental properties. Long-term rental properties are the kind of the typical old school pre-VRBO type of thing where you would go and you'd buy a property down the street that you see come up for sale or town next door, and you rent it to somebody on a year lease or 6-month lease or a couple of year tenants. The nice thing with this is it's kind of a more consistent income stream to where you can expect your monthly payments and you can know what your positive spread is between your, cost of owning it and rental income that comes in. Short-term rental properties have really, in my kind of experience or observations, boomed in the last 10-15 years with the advancement of the internet and services like VRBO and Airbnb and HomeAway and some of those services. And what's interesting, specifically even this last couple of years with COVID and some of the things where people aren't able to travel in the same capacity, go to the Disneylands and go overseas and some of the things that they might have otherwise been comfortable with, we've really seen kind of a boom in this short-term rental property profitability. And so it's really popular right now. We're hearing lots of people that are wanting to try and pick up a short-term rental because they hear their friends that were ahead of them are making good money in that. And the question is the property overvalued at this point in time? Some of those things, but also, if that starts to dry up and it's not as, profitable, you don't have the consistent renters kind of every weekend and throughout the week, you might not have the revenue to cover your mortgage payments if you have debt associated with it. So gimmies and gotchas associated with kind of each of those. One might be a little more profitable and a little more risky in today's world. The other one might be more consistent potentially depending on where it is and rent forgiveness programs with some of the COVID relief plans. And then lastly is commercial property. Obviously there's a million different ways to get into commercial property for different reasons, but I want to kind of kick that around too, because we do have some business owners on the call that might be interested in an additional building or a building that they get their office out of and then, sublet out some other space next door. So I want to talk through these concepts in larger form and then kind of talk around financing of them and your kind of understanding of how to execute that sort of thing. Sound good, buddy?
Yeah, oh, it sounds great. I'm not in the commercial property space at all. I'll tell you that. I think so. Unfortunately, I won't have much to offer in that respect. But the other three, I'm very versed in.
Perfect.
Yeah.
So questions for you.
Yes.
Jay, first question kind of right out of the gate. Anytime you want to get a property, my two things that I want to know is, how do I pay for the down payment to get into it? And then, how do I make sure I can afford it ongoing? Like what's the reasonable balance there? So in your experience, where are people going right now? What are they considering? What are things that they shouldn't consider doing from kind of finding resources?
No. Okay. So Fanny, let's talk first of all about the type of loan that you're going to be doing. So, when you're doing a mortgage or a loan, you're basically booking a flight somewhere, right? You're trying to get somewhere. And the mortgage is the airline and the plane. And of course, there's security at the airport you got to go through, right? So Fannie Mae and Freddie Mac, what we're going to talk about, those are the securitizers for conventional loans. So their rules are pretty straightforward, although there are some differences. But so you have three designations of properties. You have primary residence, second homes, and investment properties. And of course, we're talking about investment properties today. However, some of the investment properties fall into the second home category sometimes. And so the down payment amounts is what we need to talk about. So an investment property, the minimum required down payment from both Fannie Mae and Freddie Mac is 15%. That's the minimum. On a second home, the minimum down payment requirement is 10%. And so now when you put 15% down on an investment property, the interest rate and there's going to be some mortgage insurance is a little bit pricey. And so you have to weigh the options with those two. But where you should consider getting that is wherever you can. So that's where I send people to Ian all the time is where are you going to pull this money with the least amount of liability or benefit? Whether people are borrowing from their 401k or they have it in some kind of liquid money market. A lot of my clients have been taking out home equity lines of credit or doing even on their primary residence with, everyone's house is worth so much right now. So many of the clients that I see are tapping into that equity with a cash out refi on their primary residence to pull money out to purchase a second home or an investment property. Down payment can come from anywhere as long as it's not borrowed from another human. So if you can liquidate some asset that you have to move that money over to that's what I see most common, the most common way. So yeah, that's
So one of the things that we've seen that's interesting in that space, obviously, it can be risky to take equity out of your own house to go and invest. So that's not really a super suggested thing necessarily, but from a interest rate standpoint, what's interesting, and some of the clients that have been open to that from a risk tolerance standpoint, is their ability to access some of that equity to help with, not only maybe renovations on their own home to help with the valuations of that, but we've seen people take equity out, get some cash, and their payment still goes down monthly. It extends the amortization of their loan. But for a lot of our clients, they're thinking, hey, I'm going to be in this house for 10 more years and I want to retire somewhere else. So they're looking at opportunity to grab some of the equity now, put it into a second home that they're then in 10 years when they're ready to retire, able to move to, have pre-purchased the property and gotten some rental income in the interim. So that's definitely interesting. From a other standpoint, a lot of our clients utilize either their trust accounts or their brokerage accounts, which is kind of a non-qualified. I get to do anything with that money that I want. So rather than buying some real estate mutual funds, they're going to go and grab kind of the real tangible asset that may come with different tax benefits or depreciation or appreciation benefits. So what's the, you mentioned the 15% on the investment property is a little expensive. What threshold do you want to try and get to for kind of maximum efficiency? Is it 20%, 25%?
Honestly, that's so one thing, that's a case by case. I think every loan and every situation with every client has its own DNA. And with certain clients, some of the more wealthy ones with more, they'll put less down, right? They can afford the payment. And so I think that, I have a meeting with every customer that wants to do a mortgage, right? I have a good, comprehensive, transparent education meeting. And it all illuminates itself, right? It's a puzzle and we get all the pieces together and it becomes very clear what they like because you can see it side by side. 15% down, your payment's $28.60. With 20% down, it's $25.80, right? What's the difference there? And does that cash being pulled out of what account you're using or your savings, does that make that much of a difference when you're getting some you're getting some income passively? That's a decision that you have to make. One little segment that I'm going to talk about that I think is the most interesting for me. I own a short-term rental and I own a long-term rental. So the short-term rental is by far, at least right now, the most profitable one. Okay. It's a beach house. And what's interesting is and I've gone to senior management, senior underwriters on this, the second highest instances of mortgage fraud are occupancy fraud. That's when you're filling out the application and you put, do you intend to occupy the property? What is your, what are you going to do with this house? And if you mark primary residence and then you rent it out, you're committing mortgage fraud. And so you have to be careful. But in this instance, it's completely okay. Not doing the fraud, but if you check second home and then you Verbo or Airbnb that property, you're okay, is what we're doing. So you can actually put 10% down on a home up in Hood River and second home has to be defined. There's different definitions for it or what the underwriters are going to look at or Fannie Mae. You can't have a second home 10 miles away from you and, down the street. That doesn't work. And there have been exceptions for that, really rare ones for certain family issues and stuff. But as far as renting out Airbnb and all that, that cannot be a second home. But if it's in a resort style area, like I said, the coast or the mountain or whatever, you can consider that a second home and still receive rental income on a short-term rental basis. And so what you get in that sense is you get to put you can put 10% down, and the interest rates on second homes is similar to that of primary homes. The interest rates go up significantly on investment properties. The qualifications go up significantly on investment properties. We can do it's just a little bit more paperwork, honestly, but qualifying is easier. The rates are much lower. The mortgage insurance is much lower. And then you can receive all this second home income. I think that is right now the most popular thing that I'm seeing or people are attempting to do. because obviously when you do a short-term rental, you eliminate a lot of the liability as well that you have doing a long-term rental. But 10% down is pretty optimal on something like that. Now, one other thing you have to keep in mind is there are loan limits. So Fannie Mae, some people know about this, some people don't, but there's a federal regulated loan limit in the United States for mortgages. And if you want to do a conventional loan, at this time, the federal loan limit, you might want to write this down, is $548,250. Okay. That limit goes up every year. And in fact, it's already gone up for next year. The new limit, I believe, is 625, which is the largest jump in history. Okay. A lot of lenders, including us, are already using it. However, the interest rates, there's some built-in margin on that because it's early, so the rates are higher on it. But January 1st, that is going to be the loan limit. Now, there are some areas, I don't know if everyone on the call here is in Oregon or Washington or what, but if you live in a high balance area, so obviously Fannie Mae and Freddie Mac, they recognize that in certain areas, that loan limit's ridiculous, like San Diego or Seattle. And so those are considered high balance areas. They allow Fannie Mae and Freddie Mac rules, and they allow higher loan limits. And I'd have to look those up. You can easily Google Fannie Mae loan limits and you can find it in your own area, and you can also email me or whatever directly and I'll tell you or call me. But 10% down, you want to make sure that you're in that loan limit, right? Because the minute you go above that loan limit, you're in what's called a jumbo loan, right? Fannie Mae and Freddie Mac, that's like flying Delta or Alaska, right? It's easy. As long as you follow the rules, you'll get on a plane, you'll have a nice flight. Jumbo loans are like taking a private aircraft. It's going to be a little bit more expensive. It's going to be convenient, but there's more rules associated with that. And so if you're going to go into a jumbo property, like $1 million house on the beach and you're not going to be able to put 10% down on that. That's going to have to be at least 20. So I hope that answers that question, Ian. I know I can ramble a little bit, but a lot of things to know when it comes to that designation. If you can do that 10% down and do a short-term rental, that's where you're maximizing both the interest savings and the income possibilities on that.
Yeah, so that leads into kind of another question, and we may be getting ahead of ourselves, but
Sure.
From a qualification standpoint, like if I'm buying a second home, obviously I have to be able to pay both mortgage payments, have my
Yes.
debt to equity, debt to income ratio be inside the right parameters.
Yes.
Which my income would be a limiting factor potentially, and then what other properties, loans, investments, whatever I might have associated play into that formula.
Mm-hmm.
When it comes to an investment property that's going to be long-term, that's going to have a lease associated with it, it's obviously more expensive financing, more down payment.
Yeah.
How does it work from my income standpoint for qualifying for that? Do I still have to have the income at the front end to justify it and then show the renters? How does that work from a feasibility standpoint?
Great question, Ian Rice. So what Ian's talking about is debt to income, right? Fannie Mae qualifies you and Freddie Mac based on their thresholds. So the typical debt to income percentages, meaning if I make $5,000 a month and my combined debt monthly is $2,500, I'm at what's called a 50% debt to income threshold. That would include, and when you're doing a mortgage, what they calculate as a payment is the principal and interest payment, any HOAs you might have, if there are HOAs on the property, divided by 12, if it's a monthly, or if it's annual, you want to make sure it's the monthly. And of course, taxes on the property and insurance on the property. That's considered what they call PITI, principal, interest, taxes, insurance, and of course there's the HOA. And then mortgage insurance also, that would be included. Cable bills and all that other stuff, they don't care about that. And then anything on your credit report, that would be, your credit card payments, your car payments, anything that's listed on there. Student loans would be a factor too. And there's some interesting things about student loans, since everyone right now is in deferment, how Fannie Mae and Freddie Mac both utilize that. I'll just tell you, if you're in deferment on a student loan and it's on your credit report, Fannie Mae requires that we put 1% of the balance as a payment, and Freddie Mac allows us to use 0.5%. And in that situation, sometimes that qualifies people. Moving forward, the debt to income, Fannie Mae and Freddie Mac also both use, when you're getting approved for a loan, it's like going through security at the airport again. There's two points of approval. There's an automated approval where basically, I'll look at the camera, sorry, I'm not used to these Zoom things. So there's the automated approval, and then there's the human approval. The automated approval is a very comprehensive software that's been around for years. It's always being updated. And it reads basically your life, your debt, your history, your job, everything I put in the system, and it spits out whether you're approved or not. In a lot of cases with people who have great credit scores, great sources of income, those kinds of things, I can get up to 50% debt to income approved through those sources. And so it's insane how many people are actually approved for these things without seeming like they should be. However, if you then are, you're still like, let's say you're at 53% debt to income after I put the new rental property in there. If it's a long-term rental, when we order the appraisal for that property, we order an extra little schedule or little report that the appraiser has to accomplish. We call it a 1007. It's called a rent schedule. And they analyze comprehensively what the rents are in the area of the house that you're renting. And they come to a number. Hey, this house rents for $1,000 a month, which is ridiculous, I know. And what we do is we take that number that they put on the appraisal and we take 75% of whatever that number is, and we apply it as income for you so you can qualify for that rental property. Okay, if you don't going into it, understood? So what Ian's saying is good in the sense that, let's say you wanted to buy a house at the beach and, maybe you're self-employed. And so when I put your income through Fannie Mae's calculation, because you write so much stuff off and you don't have all these things, you don't qualify. Well, you could then, if you really want the property and there's still a benefit of it, you would convert that loan to even though you could do a second home loan, you convert it to an investment property, because then you can at least qualify for it as I get a rent schedule done on it, right? Those are instances where we would convert that and you pay a higher rate and it would be a little bit more of a difficult loan, not much, but then you could at least procure the property. So yeah, those are the things that once we get the DNA of the customer and what they're doing, we can put them in the most efficient loan possible, so they can achieve the goal of the home, and if it's not worth it, it's not worth it. But I think, yeah, debt to income is one of those fluid things. It's not a standard thing. I have some customers that can go up to 50%, and somewhere once I pass 45%, it says no, you know what I mean? So it's kind of whatever you qualify for. There are rules with that. So you have to be retirement age to do that. Now, which, while Fannie Mae and Freddie Mac are super lenient and have crazy, like they want loans, if you have a bunch of assets and you don't make any money, you're not getting a house. It's just not going to happen. There are loans out there. They're called non-qualified mortgages, and those are loans where they took a complete. They were really flying high, and before what happened in the pandemic, they were starting to really come back. We had them. I didn't do any of them, but I remember seeing them. Where you could do asset-based lending again, like you could before. The rates were way higher, you have more things to deal with, but there's still stuff like that out there. Those are difficult loans to do. You still have to provide proof of certain things, but as far as doing a conventional loan like that, yeah, I've seen some people. I have some people like divorcees or something that have all these assets and they're not working, they can't qualify, and their parents have to co-sign for them. You know what I mean? It's kind of, and then they're taking out distributions to do it, because they're retired. It's kind of a funny way we do it. But you just got to play by the rules with those guys. If you follow Fannie Mae's rules, you can get anything done, fairly easily. A lot of big lenders, like big banks, have what are called overlays. So when a Fannie Mae guideline comes out, like here, I'll give you an example. This is a basic one. One of Fannie Mae's guidelines is you have to have a 620 credit score, right? That's what they say. So if you have a 619 credit score, you're not getting a loan through them. Well, if you go to Wells Fargo, they might have what's called an overlay where you have to have a 640 credit score, right? That's a very basic overlay, but some of these bigger banks and other lenders that sell their loans to certain channels, they have overlays. So you might need, their second home stuff might have more qualifications. You always want to look for a lender that doesn't have overlays. They're the best, like us, right? We don't have them, but a lot of lenders don't. We're not the only ones. It's very common to just to go off what they say. And that way you can get a 50% debt to income done or stuff like that.
So the quick question that came through in the loan limits for the conventional loan limits, is that both loans together, or is it primary and secondary separate?
No, if you have 10 houses, it's just that particular loan. Yeah, that's it. Yeah, you can have 10 loans and 10 houses, and as long as you're under that limit when you do it, then you're good to go.
So another question rolled through right behind that, kind of on the same topic. It says, if I'm a co-signer on a Fannie Mae student loan for my daughter, does bringing a co-signer figure into the debt income ratio? So does that, if she's co-signed on a loan for her daughter
Student loan.
on a student loan, does that responsibility reduce their eligibility for conventional loans?
It absolutely does. It can, yes. Now, there is a rule with Fannie Mae and Freddie Mac on all installment loans, which I believe a student loan is. If you can provide proof of the last 12 months payments coming from the other person. So if you have a car loan, right, on your credit report, and I've done this with husbands and wives. Sometimes a husband and wife, you know, or partners, one person has the loan and it's a joint loan, but they have different separate checking accounts. I've actually had this done before. If you can prove that the other party on the loan has made all 12 payments for the last 12 months, you'd have to get proof of that with bank statements and stuff. You can exclude that debt from the debt ratio. Okay. The problem with student loans is they're always in deferment. And so it's impossible to get that 12-month history, right? It's very difficult. So that the answer is yes and no, right? It depends on how you did it.
Perfect.
Yeah.
So question number D, letter D, whatever we're going to.
Yeah.
From a tax benefits, passive income, asset appreciation, obviously, whether you own a house as a primary residence, a secondary residence, investment property, it'll appreciate the same. The wear and tear might be different if people are, you know, if you have it at Mount Bachelor during, you know, spring break and somebody trashes it, but
expenses. Yeah, there's expenses. Yeah.
Or, you know, the nightmare stories of getting a tenant that, you know, starts cooking something in the bathroom and, you know, now your house is ruined and you've got to, you know, figure it out. So from that standpoint, that's obviously risk associated with each one. Passive income varies depending on, you know, that sort of thing. Is there a big tax difference? And obviously neither you or I are tax advisors.
No.
Is there a big tax difference from an interest deduction of an investment property versus a secondary home?
I am not permitted to talk about that stuff. And with customers, I don't know. I'm sorry. I cannot tell you that. I have no idea. This is my first year having both on my tax return. So we'll find out. You know, I did this last year. So
so from my very limited understanding of taxes, one of the things just to keep in mind is if you're trying to fight taxes on W-2 income with investment property write-offs, you're not going to get very far because you got to have investment income to go against investment losses or depreciation. So it could internally function on itself as a tax benefit, but until you get multiple, you know, investment income streams that aren't tied to W-2 income or 1099 business income, you're not going to have much additional benefit beyond kind of the internal functioning of itself against that W-2 income.
Yeah, I see a lot of I see a lot of depreciation on Schedule E's, they call it, you know, that tend to reduce that liability, but I don't know beyond that. No, I don't know much more than that. I'm sorry. I apologize for not being that much of an expert.
That's all right. Opportunity in that, obviously consult with a tax professional. If you're trying to buy property for tax benefits, obviously you should be talking not to a mortgage broker or a real estate agent, but to a tax advisor to see, you know, how does it actually impact? Does it make a difference? Interesting topic real quick on the depreciation is, you know, the depreciation is really popular because what it does is it takes your cost basis and says you paid, you know, 200 grand of your money into this property and it's worth X amount. We're going to start depreciating that cost basis out. When you get to the end of it and need to sell it, you need some type of an exit plan because you're kind of deferring taxes to some future state. So you just want to know kind of why and in what direction you're driving. So no more questions yet. So let's keep rolling here. I always like to ask this question. Why would you buy points or not buy points? That always seems to come up in the conversation of, you know, wiggling around there.
Yeah.
Can you give us your 2 cents on buying points in an investment?
Absolutely. Absolutely. This is a big part of what I do. I really try to educate people on how we make money. You know, the mortgage world is very convoluted and they make it very difficult for people to understand what the heck's going on when it comes to that part. I can teach everyone here I can make everyone on this call the best mortgage shopper on the planet. Okay, if you want, ever, just let me know. That promises to pay people back, right? How do we make money on it? Well, a market's been created for that piece of paper. Fannie Mae and Freddie Mac securitize that mortgage, and then Wells Fargo or some giant bank buys it. It's no different than, I mean, it is different, but my best analogy that I created was, I raised this cow, I spend all the money on it. I follow all the guidelines to doing it perfectly, and then I sell it, right? And I get paid by the pound maybe, and then it gives milk for 30 years to whoever purchased it as it gets traded and sold more and more. And if the cow ever dies, Fannie Mae gets to pay out an insurance policy to whoever purchased it. The cow is the loan in this situation, by the way. Okay, so, but here's the denomination of which we're compensated. So lenders sell loans on basis points. So points. So the average lender in the United States, I mean, retail like us, we make about 2% per loan we do. That, some are higher, some are lower. That's the national average. And so on a $400,000 mortgage, the lender's grossing about $8,000 on that. Okay, give or take. All right, it's a lot of money, and you can understand now why it's profitable business. However, we don't keep all that. There's expenses that go along with that. Okay, but here what they're saying is so let's just do an example. So assuming this is assumptions are very important when you're reading rates. So assumption would be 740 credit score, 25% down, a single family residence, not a condo or anything else, not a manufactured home. 20, did I say 25% down already? Yeah, 25% down. You're going to include your tax insurance in your payment, and all those things have to be there. And now it's the time of day that matters because rates move every hour. And then what are the margins of the lender? All of those come together at one point to give you an interest rate. When you reduce that interest rate, right, you reduce the amount of percentage points the lender's earning, right? So if you look at Wells Fargo's mortgage rates, they might say 3 1/8, and you'll see behind that this APR of like 3 1/4, and they're different numbers, and people get very confused by that because APR stands for annual percentage rate, but in a mortgage, it completely has nothing to do with the rate. What it's basically saying is they're reducing that interest rate, and because they're doing that, they're losing money. And so they have to retain that money by charging you points. So when they advertise a rate that's low, what they're saying is if you meet all these criteria, you can get this rate, but it's going to cost you 0.5 point because it cost us 0.5 point. So when I said the national average is 2% of the loan, we might only be making 1.5% on the rate that you're seeing. And so you have to make up that difference by writing us a check. And so if you're borrowing $400,000, 0.5 point would be $2,000. And so your closing costs would increase by that much. And so whether it's a good idea, I know that's a lot. It's a lot easier if I have my screen share up and I can show you live. But basically, the only way to decide whether buying points is beneficial is the lender really should share their rate sheet with you, because it's not that simple. So sometimes I might have a rate of 2.99 on the screen, and that's what we call the par interest rate. Par means even, right? I'm sure there's golfers on this call. I'm not one, but par means even. And so that means that we're not making more than 2 points. We're not making less than 2 points. This is exactly what your rate should be based on our situation. And then 2.875 might be where it might say we are losing 0.275 points to do this. Well, that might be worth it. It's a small amount, 0.275, right? To reduce your rate by 1/8. And so you have to decide, is this cash enough to lower my payment this much? And so you just take it. If it's $32 a month, if it's $26 a month less, but it costs me $800, you divide 26 and 800. How many months does it take to recover that, right? And that's when you go to Ian and you say, Ian, man, should I keep this $5,000 and give it to you or whatever, right? What can I do with this over 5 years versus save this amount of money? Because sometimes the points, they're really weird. Sometimes it's a tiny bit to get the rate down, and sometimes it's like a full 0.75 to move it 1/8, and it's not worth it. And so I'd say most of my clients don't end up buying points necessarily. Sometimes it's worth it because it's such a small amount, but at the end of the day, I teach the customer, and I'm very transparent. I show them the sheet and they decide if it's worth it or not. And so really it's based on what the situation is at the time. Like I said, the DNA has to be, it's your DNA on it. And so that's your decision. But you got to get educated on it so you understand how to read that, right? So I hope that, I know that it doesn't, like, you don't get a yes or no on that, because it shouldn't be a yes or no. It's really based on what's most, if you're a senior citizen and you got 10 years, 15 years left in your life, no, you don't buy points. In fact, you take a higher rate and get points back from me, right? Because you're not going to live the mortgage out. So there's, if you're a young person and you're very conservative and you listen to Dave Ramsey and you want to pay, and your goal in life is to pay your house off, yeah, maybe you buy some points, right? That makes sense. The average customer in the United States keeps the mortgage less than 2 years now. I think it's right around 2 years. That's it. Whether they're selling it, refinancing it, whatever, right? We're in a most volatile market. I've been doing this for 10 years. The last 5 years, it's been a roller coaster ride, man. Up, down, up, down, up, down, values up, values down. And people are using that to leverage their properties and refinance constantly. I myself have refinanced my own house like 3 times in the last 4 years. It's insane. And so I think if you buying points is that's for long-term mortgage stuff, right? Not, and most people are in the short-term market, whether they know it or not, they really are, because that's the national average. And that's probably what's going to happen to you. So.
Interesting you bring that up. Next slide here is, why do you think people are prioritizing mortgage payoff when those numbers are so low? Like, is it lack of foresight? Is it like past money blueprints, what dad told them to do? Like,
yeah.
What do you think? What do you think is the reason people are still prioritizing?
Great question. Great. So I think, this is, as I get older, I start to say like fortune cookie things. And I invent them. It's really cool. I feel like a wise man, right? But I think that, and I've said this for a while now, I think people do things mostly because it's the way it's always been done, right? And I think people's parents always tell them, you got to put 20% down to avoid mortgage insurance. Well, yeah, but mortgage insurance is really, really cheap if you got good credit, right? And you could take that money and divert it and do all kinds of crazy stuff. So I think that's why they just don't know. I prioritize education. I want customers to learn, so I am not the one that makes a decision for them, right? And it's so many people come into my office and sit across, because we do a lot of face-to-face, and they say, well, we know we need 20% down. I go, you really don't. You need 3 or 5. And they're like, really? We don't? Oh my gosh. And they were planning on saving for 4 years. You know what I mean? Really, it's just it's completely a lack of knowledge. Because with the rates where they are right now, every 10 grand down is only $46, $45, $43, $44 a month in payment, right? It's nothing. And so not nothing, but if you have 2 houses next to each other and they're both amazing and one's 20 grand more, that's $100 more a month, right? It's not that different. And so dumping 20, 30, 40, 50 grand into your mortgage to lower your payment, 100, $200 is not really, I don't know, with the limited amount of savings some people have, I don't think it's a good idea. It's not up to me to decide if it's a good idea or not, but it shouldn't prohibit you from buying a home at all, because the payments aren't that much different. So it's just knowledge. It's complete lack of knowledge. Like I said, if you look online for mortgage information, it is very difficult to find anything that makes any sense to you, right? They convolute it with terminologies, and it's not that difficult. And very few people in my profession will sit down for 2 hours and go over it with you, right? And so really, it takes that long. I think I'm the only human that can explain the points things and do it on a screen in less than 10 minutes. I mean, it's really difficult for people to understand it. And that's over 10 years, I figured that out. It's confusing, and they lean on these folks that really don't spend the time to go over that. So yeah, I think it's just knowledge. It's complete lack of education. It's just not out there.
Another question rolled through kind of on that topic. As far as closing costs, are they negotiable? Like rolling them into the loan, lender paid? Are they like points?
Yeah, not really. I mean, closing costs are very regulated. So back in the day, when I say back in the day, that means before the mortgage meltdown. Okay. So I call it prior mortgage 9/11, right? So after that, you have massive regulation, massive oversight, all these rules. Lenders used to just arbitrarily put costs in their stuff because they could, right? So, it's like the car business gets a bad rap from the 80s and 90s, right? Because if the customer doesn't know anything, they paid more, right? If the customer was educated, they paid less. That was like the dealership going, hey, we can get this guy, or get this person. Well, in the mortgage business was just like that. If you had a customer who just wanted to buy a house, I mean, everyone here watched The Big Short, some of us 10 times, 12 times. Okay. They would just charge more fee if they could, and that was the source of profit. Well, you can't do that anymore. the national average for what a lender charges on a closing cost breakdown is $1,500, period. That's an underwriting and a processing fee. The rest of the fees, so if you're comparing closing costs from lender to lender, I'm not going to say you're wasting your time, but it's a lot of, it's time not well spent. And here's why. The cost of doing a loan, 80 to 90% of it goes with the house, not the lender, right? You have the title company, you have the title insurance, which is regulated by the state you're in. You have the property taxes, which is part of that, the insurance, which you're going to get, the county recording fees. The only fees the lender is going to have, or the process, that one little fee that they're going to charge, that's national average 1,500, and an appraisal, which could range from, right now there's sometimes we're known for closing really fast here. I can do a loan in 10 days in a lot of cases. Well, if I do that, I don't like the word caveat, but I'm going to use it. The caveat to that is I have to, it's just because I don't like the way the word sounds, but basically, sometimes I'm charging 1,500 to $2,000 for an appraisal because I got to get one of these lazy schmohawks out at the coast to do it really fast, right? And that's what just needs to happen, right? But in the end of the day, they're going to be close. So yeah, and you can't just roll them into the loan. No, you cannot do that. The way to roll it into the loan is to get the seller to cover it, right? So the seller can contribute a closing cost, and that's kind of the way to do it. But you can't just add it to the loan. That's never allowed. So if your down payment's 10%, it's 10% plus closing costs, unless the seller credits you. Let's say closing costs are $10,000 and the seller's selling the house for 500. You can negotiate. Maybe, can I buy it for 510? And you credit me 10 grand, you could do that, right? And that increases your payment by $43 or whatever. And then you don't have to come up with 10 grand. That's the way to do that, but you can't just have it added.
Okay.
Yeah.
All right. Two questions came in. One of them will take a little bit more time. One of them is, how can I finance a home in Mexico?
You cannot right now. My business partner here bought a lot of land down there. And he was going to build a home there and then like rent it and kind of own it. He's very frugal. It's like his big thing for him to do. And so he's very excited, but now he's very depressed because he cannot find a lender for it to build the property or to finance anything down there. It's a real lack of, if anyone is a pioneer out there listening to this call, there may be a source to start a business there, because and I shouldn't say there isn't, because there's always something if you dig hard enough, but I have not seen or found or heard, and because he's actively looking and he cannot find any resource to finance a home in Mexico right now.
Do we expect that to change in the coming years?
I don't live or work in that space at all, but I can't imagine there isn't someone working on it. There's so many people trying to go and buy homes there. Right, you're right, short-term rental, like beach houses right now, houses in Bend and Hood River and these Forks, Washington, and all these, it doesn't matter. It's exploding, and it's so competitive right now, and highly aggressively, people are just wanting to buy these things. And so Mexico is clearly getting interest because it's cheaper, it's beautiful. And from what he is telling me, he cannot find a good lending source for anything down there right now. Yeah, and so there's definitely some money to be made somewhere with that. I'm sure of it. Yeah.
So we had another question come through, but it goes kind of hand in hand with our next slide.
Sure.
And so in this, do you think having a paid off home is still worth what it was 30 years ago? And the question that rolled through at the same time is, if our house is 80% paid, is it better to invest versus paying off the rest of the loan?
That's an Ian Rice question. I'm not a financial advisor, nor do I ever pretend to be one. However, I'll just give you my opinion. It depends on you. I think, like I said, here's what I tell customers. Some people are like my parents, are just not comfortable leveraging. They're not comfortable at night when they go to bed borrowing money against anything, right? It's their DNA can't handle it, right? They're very annoying. My dad gets receipts from gas stations, and he does it even so if he forgets the receipt, he goes back and has them go through their receipt and it's so horrible. Anyway, so it's like, I would never try to talk or advise my parents to do that, right? It's just, so for them having a paid off home. But if you can educate yourself and sit down and go through some of this scenarios with Ian or people like Ian, and illuminate the lack of risk that maybe it could be, right? I mean, look, if I'm gonna pay, if I have a paid off house and I have access, I'm just living there free and clear, and I'm on a very fixed income, and I'm gardening, and I go on a little tiny trip to Reno once a year, but I desire to do more. Yeah, I think there's an opportunity there that you're just wasting, because you could take that money out, redeploy it, and maybe create some wealth for yourself. But that's where Ian comes in, not me. So personally, my personal opinion is I don't ever want to pay my house off, right? I'm excited to have a reverse mortgage someday, right? I just, I've educated myself about it. I don't care if my kids have any inheritance whatsoever, as long as, I'll leave them enough to bury me. But other than that, I will swamp that equity in my property and live a wonderful life. So I think it's based on, you got to educate yourself on what the money's going to do if you start to leverage it. But then, like I said, there's some people that just crave this desire. They just have this desire to have no debt, right? And I think that's fine. I think if that's your DNA and that's what makes you happy and sleep at night, then do that, right? I personally don't want to do that. I want to have more and more, so I can do more and contribute more and have more, my kids and go to a better college, whatever. It's the way I feel comfortable. My wife is more of a payoff thing kind of person. So we balance that out by doing both. So I hope that answers that. It's more of an opinion more than any advice, I think.
Yeah, I guess kind of our take on it is, the historic viewpoint of you have to pay off your house came from kind of the 80s when interest rates were 13, 15, 18% on a mortgage. And there's nothing in the world that exists that's going to consistently and safely do anything like that. We're not going to advocate to take money out of a house equity and invest it. But, as you look at, the world, like, your house is never actually paid off in our mind, because you still have property taxes, you still have insurance, you still have upkeep. So, like, we need to understand cash flows and goals and priorities. And, we think that you should enjoy your money and, however you can enjoy it. Some people, the peace of mind and enjoyment of a paid off house is fantastic.
Yeah.
Some people that doesn't bring them any joy, and, they may be walking away from some potential mortgage interest write-offs associated with having paid off their house that, they could have otherwise, maybe got a second home that added more benefits than paying off the first home. Or, it's a goals driven, cash flow driven, what exposure do you have? There's interesting accounts from back in the day that, still exist out there. You can't buy them anymore, but there's accounts that pay, 3-4% guaranteed interest rates. In the old days, CDs were paying 5%. So if you're loaning at 2% and you have a CD that's paying 5% or some account, it might not make sense at this point today to cancel that, account that's earning you more than it's costing you to keep your mortgage. So it's an if then, larger conversation. So sorry, we can't give you an exact answer, but that's where you would need counsel from multiple professionals at the same time.
Back to my parents, and this contradicts everything I just said almost. Well, it just does, because I talked my parents into this. My mom and both my parents have a little bit of cancer. It's the kind of cancer our DNA has. My mom's got a little bone cancer. It's going to last for a long time. She'll have it forever. My dad's got prostate cancer. I think we're born with that in my family. Anyway, that kind of triggered something for them. They, being trapped at home and COVID and all that, I talked them into pulling $100,000 out of their property, and they bought an RV. And that was highly, and they love it. They, my mom has chemo every other Monday, but in between they go to these trips, and they, my dad gets all the gas receipts on the trip, but they basically go and they're doing that. And basically what I did is I spread their payment out 30 years, right? So their payment didn't even change, right? And so on their house, they just decided we're never going to pay our house off. We're not going to live that long. And they just did that. And now I'm seeing more joy from them, right? My dad's 85. And so, like I said, it's based on what you're going through, right? Cancer will make you do things like buy an RV and tap out equity when you're the most conservative, frugal people on earth. So hope that helps a little bit.
For sure. And we have probably 6-7 minutes left here in our time together. A couple of additional questions.
Yeah. Love questions.
With a roaring housing market, and let me see, I can't read it. Your face is in the way. with a roaring housing market, would you ever use or recommend interest-only loans with balloon payments in today's crazy low interest rate environments?
I don't do them. The rates are low enough on the other ones. You know what I mean? Like a jumbo 30-year fixed, I can get, I mean, I'm not supposed to quote rates. I won't, I'll say it like in a funny way, but, and rates are by the way, rates are going up. I don't know if anyone's been watching the news or anything like that, but they're going up. So they're, you know, the 2 point whatevers, they're out there still. If you want to use a lender that does that, you know, they don't have much overhead. So that's kind of not a great experience. Kind of like booking a really cheap flight. There's usually a reason. But most of the competent lenders are over 3% now, which is ridiculously still low. But to save 1/8 of a point to go interest only or something like that, or maybe even 0.375 or even a half, I don't know if it's worth it. When you can get a 30-year fixed jumbo loan at 3.125 or something like that, if you can do that fixed completely, because the interest only loans are all adjustable rates. They're not 30-year fixed. Now, adjustable rate mortgages are not as dangerous as they used to be. You can't all of a sudden have 9% interest in you know, when they you know, and that's a whole nother you know, if you ever want to talk to me about that, it's a longer conversation on how that works. But the first adjustment in most cases can only go up like a point or two. I think, yeah, but you know, the reason people do that is the payment's lower. That's why, right? Not, and so, you know, I think if it's a 5-year arm with an interest only payment and that's what you want to do, I know friends that do that. It allows them to relocate their money into other things. And so the balloon thing I never see. I don't know who's doing that these days. I have not seen that in years. We don't have it. It's just not available as far as I know. If anyone's doing that, I don't know who they are. But the arms I see, I just think you have to talk to Ian about it and look at the risks, because 5 years is a long time. You know, and within that 5 years, there's no prepayment penalty. You can always just refinance it into a 30-year fix when you've achieved what you wanted to achieve. But if you're doing an arm just to lower your payment for 5 years, I'm not so sure that's a great idea. If it's not that much different, but it's not my place to say that. I just think the rates on the other ones, you're not doing it for the rate. You're doing that just because of the cash flow issue, which I think is valid in some cases. I have a friend who leverages his entire life, his brokerage account, everything, and he has like $1 million interest only loan on his house, and he just pays the interest, and he seems to know what he's doing there. So I think it's about getting educated with your financial advisor on
that. Thank you. A couple more questions came in. Are the rules different for multi-unit investment properties versus single unit investment properties?
Absolutely, they are. And if everyone wants to do this on their own, feel free. You just want to Google Fannie Mae eligibility matrix, okay? And on the eligibility matrix, you can see what the not the debt to income, what the loan to value requirements are. So you need 20, like a multi-unit property. If it's an investment property, you need more down payment, 25%, okay? In most cases on that. But other than that, really the down payment's the only big difference. Sometimes Fannie Mae, so a lot of people ask, well, they don't think about, and I tell them about reserves. Okay. So Fannie Mae, Freddie Mac, jumbo loans especially will want reserves on sometimes on these. When you own multiple properties, they also want you to demonstrate the ability to make the payments for a few months if something happens. And so, and reserves can be demonstrated by any account that could be liquidated. It could be a 401k, it could be a retirement account, anything that you can pull and leave. Like I always say, if you were going to ever go and be a fugitive, tell me about the money you could take out, even if it's taxed, right? And that we can utilize as reserves. So sometimes when you buy a quadplex, right, a 4-unit property, sometimes Fannie Mae will say, hey, we need more reserves. It's not a standard amount. It's not, you need 6 months, you need 2 months. When I run that automated approval, it'll tell me exactly what you need, right? And sometimes sometimes with second homes, if the credit's great, debt to income's great, Fannie Mae won't require any reserves. But when you're doing multi-unit properties, almost every time there's some reserve requirement that you'll need.
Cool.
Yeah.
A handful more questions and we're running short on time.
Of
so
course.
Now that you mentioned the RV, can someone buy an RV and then rent it out as an investment? I know near and dear to your heart.
Don't do it. There, I'll give you some advice. Don't do it. So there's those websites, what is it called? RV Share and Outdoorsy. So we tried this to help out a sister-in-law. We were creating a job for her, right? And we ended up doing it. And now we're a little more, we're obsessive about how we do things. So we ran this RV business. I will tell you, the only reason I would ever do it again is if I wanted to be an RV person and use it a lot. So I wanted to take my family 5, 6, 7, 8, 10 times a year and go somewhere. It's a way to afford the RV. You can put it on those websites and you can get a lot of money for it. But we did it full time with 2 RVs, and they're both for sale right now. If anyone wants to buy one of them, they're really great, but they break all the time. Okay. And people who rent them don't own them. And that means they don't know how to use them. And so your life is, even with the comprehensive education that I gave people, the phone calls and the problems that would, one of them had an exhaust pipe blow
I'm cutting you off, Jay. We're running out of time.
All right, sorry. Don't do it. Or call me privately and I'll tell you not to do it. Okay. What else?
From a functional standpoint, we don't love that idea because you take it from an appreciating asset to a depreciating asset, and it's tough.
It's a way to afford it, but that's it.
Yep. Let me see questions. I hear the investment properties should do a 15-year loan instead of a 30-year. Why would that be said? I think that lends back to the original kind of like, you want to get out of debt and have it cash flow positive sooner than later, more positively sooner than later.
Yeah. Plus the interest rates on 15s, they're lower, but I'll just real quick tell you this, typically, not all the time, but typically if you make the 15-year payment on the 30-year loan, so you buy the 30-year loan, but you make the 15-year payment, you'll add 8 months. The interest rate difference will add about average 8 months to the total term. So it'll be 15 years and 8 months. So having the 30-year term gives you a safety net in case you have a huge sudden financial change in your life. And all of a sudden you have this giant payment. If you have the 30, you can just make that lower one. I don't talk people out of it, but I will use that math, and then customers will almost always go 30 because you can always pay it off whenever you want. Every loan in the country Fannie Mae has no prepayment penalty. You can pay it off as fast as you want and pay less interest. That's an option.
Awesome.
Yeah.
We are out of time, out of respect to everybody's day and it being a Tuesday morning and, running and getting to life. I think that's all of our questions that we hit. If you have more questions, let us
call that number. Call that number. I for the next 2 hours, I have nothing except just work. If anyone wants to call me anytime, day or night, on that number right there, or text me, or email's fine too. Just go ahead and I'd be happy to answer anybody's questions. Okay?
Awesome. Appreciate it. Appreciate your time. From a self-plug standpoint, we have more webinars every month or so. We have more webinars coming up. Check it out on our website. We'll email you about it. We appreciate your time, Jay, your expertise.
Thank you. This was fun.
Look forward to doing it again someday. If anybody has questions for us, you know how to get a hold of us. And enjoy the rest of your Tuesday.
I promise. See you, buddy.
All right, guys. Thanks for your time, and we'll talk to you soon.
Take care.